Okay, so today we're going to present on our stock market PID. We are Costco's financial analyst team, and you are Craig Jelinek, our loyal CEO. So Craig, you sent us on a mission to understand the stock market a little bit more. You're happy at $52,000 a year, your salary. The Costco employees are happy at $20 an hour average across the nation. But one thing that you are a little concerned with is our main competitor. They're really strong right now in the stock market. Who's our main competitor? Walmart, right? So we want to understand something very important. We want to understand what is it that determines the value of our stock price. Is it the market, or can we engineer our own stock value? So that is our main question right here. Can we engineer our own stock value? So what we did was we took data from the last 5 years on Google Finance from the end of the recession till today, and created a second order plus dead time model, and from that created a PID to engineer the stock price. Our manipulated variable, as you can see here, is the dividend payout, and the controlled variable was the rate of our stock price increase.
So we took our pretty standard FOPDT Excel functions and we expanded them to give us a second order transfer function. Our dividend payout that we use for our manipulated variables is constantly increasing over time. We couldn't convince Costco to give us a doublet test on their dividend payouts, especially go negative, but they still had fairly responsible dividend payouts over time. So we were able to develop these two single order transfer functions that we multiplied together to get our second order transfer function. And this is the block diagram of our model, which is pretty typical, except that there's two major differences. That our set point is a ramp, which will give us a dollar increase in stock value per year, and we also gave 3 random number generators as disturbances in the market from the market. This graph is a graph of those disturbances. So there's one that's daily; it's pretty rapid, just little market fluctuations, and the pink is our weekly disturbances, and the green is a larger yearly disturbance, such as a Democratic election winning or something. I'm just kidding. And then it took us quite a little while to tinker with our PID to get it to follow fairly well. And with an $18 per year increase, this is how close we're able to get it to follow, given quarterly dividend payouts. So these are reasonable dividend payouts without being too fast or costing the company too much.
So now let's apply this PID to maybe what we would use it for. Let's say we want a $30 per year increase in our stock price, and we're paying out dividends quarterly. As you can see, it doesn't quite follow our ramp rate exactly. There's a little bit of fluctuation. And so to get a little bit more control on our stock price so that our stockholders are happy, what we might have to do is pay dividends out on a weekly basis. As you can see, though, our dividends are a higher value than they were in the quarterly dividend payout section. Also, paying dividends out every week has its disadvantage. That's quite expensive. So if we do want this variability to decrease, understand that it comes at the cost of paying higher dividends more frequently. So in conclusion, we successfully created a stock market PID, and as we mentioned, a higher stock price increased ramp rate requires higher dividend payouts at a higher value and at a greater frequency. We also noted that maybe in the future we could do a controller that would include maybe a recession in the middle to increase the usability of our stock market PID. So that's it.